A dying video game store with no future suddenly becomes the center of the financial universe. A group of Reddit users make millions, hedge funds lose billions. This wasn't just a stock trade, it was a digital revolution. But not everyone won. In today's video, we break down why GameStop made or broke millions, and how it changed the stock market forever. What was happening with GameStop? GameStop, ticker symbol GME, was once a thriving retail chain. But by 2020, it was seen as a dinosaur. Physical video game sales were dying, digital downloads were taking over, and GameStop was closing stores. Its stock was trading below $5. Big hedge funds saw this and placed massive bets that the stock would keep falling. This is called short selling. They borrowed GME shares and sold them, planning to buy them back cheaper later and pocket the difference. At one point, GameStop was one of the most shorted stocks on the market. Over 140% of its float was sold short. That's not just risky. That's historically dangerous. Enter Reddit, the Wall Street Bets Rebellion. On Reddit, a growing community called Wall Street Bets noticed the absurd short interest. One user, Roaring Kitty, real name Keith Gill, shared his belief that GameStop was undervalued. He posted regular updates on his $50,000 investment in GME, and others started following. The logic? If enough people bought and held GME, the hedge funds would be forced to cover their shorts, buying back the shares at higher prices, creating a short squeeze. What followed was nothing short of insane. In January 2021, the price rocketed from $20 to $40, then $80, and finally peaked at $483. A stock worth pennies was suddenly worth more than Ford or Delta Airlines. The fallout: who won and who lost? Winners: Keith Gill reportedly turned his $50,000 into $50 million at peak. Some early Reddit traders made millions overnight. Others paid off student loans, mortgages, or became financially free. Losers: hedge fund Melvin Capital lost over $6 billion and eventually shut down. Many retail investors who bought near the top lost 50 to 90% of their money when GME crashed back down to earth. Robinhood, the commission-free trading app, faced backlash for restricting GME trading, causing public outrage and congressional hearings. What actually happened? Let's simplify this. A short squeeze happens when people betting against a stock are forced to buy it back at higher prices to cover their losses. This buying creates even more upward pressure. It's like lighting a fire under a rocket. And once it starts, it feeds itself, until it runs out of fuel. What made this different was the internet. Thousands of small investors, organized on social media, acted like a swarm. They beat billionaires at their own game. At least, some did. But the mechanics are still brutal. As prices soared, so did greed. Many held too long. They ignored fundamentals. They thought it would never end. What changed forever? GameStop wasn't just a stock, it became a symbol. A meme. A movement. It exposed how fragile the financial system can be when billions of dollars are at stake. It questioned how apps like Robinhood make money. Spoiler: they sell your trade data to hedge funds. It also showed that retail investors are no longer powerless. They can move markets. But with that power comes responsibility. Lessons to learn. Don't chase hype. Understand risk versus reward. Always ask, why is this stock moving? What's driving it? Timing matters. Buying too late is just as dangerous as not buying at all. If you make a big gain, don't forget to take some profits. Did you ride the GameStop roller coaster? Did you win big, or lose it all? Drop your story in the comments. Want more deep dives into crazy stock stories? Hit that subscribe button and join the Mindful Money family.